When it comes to investing, few names matter more than Berkshire Hathaway. With massive cash reserves and strategic stock positions, the company's moves are closely watched by investors worldwide. Let's break down what's really happening.
Imagine opening a corporate financial document and finding enough raw liquid cash to literally purchase a sovereign nation outright.
Right, like no leverage, no loans, just pure cash.
Exactly. That is exactly what happens when you look at the first quarter 2026 balance sheet we are diving into today. You'd expect a map of a company's finances to have, I don't know, some logical proportion. But we're looking at this diagnostic landscape where the normal rules of scale are just, they're completely broken.
Oh, absolutely. It requires a total recalibration of how you think about capital.
hmm
I mean, when a single entity controls a baseline of assets that dwarfs the GDP of most countries, standard corporate benchmarks simply stop applying.
Yeah, they really do. And that brings us to our mission for you today. We are unpacking Berkshire Hathaway's Q1 2026 10Q filing.
A massive, dense document.
Very dense. But whether you are an active investor, a business student, or just someone who's insanely curious about how the absolute biggest players move money around the global board, this document serves as a cheat sheet to the current macroeconomic environment.
It really is a cheat sheet, yeah.
We have a corporate titan holding $1.25 trillion with a T in total assets. So we are going to translate hundreds of pages of dense accounting tables into a clear picture of what they're actually preparing for.
Okay, let's unpack this, starting with that cash pile. Because the composition of it made me do a complete double take.
I don't blame you. The asset side of this balance sheet tells a very deliberate story, and it's primarily written in U.S. government debt.
The numbers are just staggering. The company is holding $339.2 billion in short-term U.S. Treasury bills. And then you add in the $58 billion in cash and cash equivalents spread across their operating businesses, and you are brushing up against like $400 billion in pure liquidity.
Right. But the key here is they didn't just passively accumulate this over time.
No, they are aggressively pulling chips off the table. During the first 3 months of 2026, the filing shows they dumped $24.1 billion in equity securities.
Yeah, that's a massive offload. They sold $24 billion worth of stock, which generated $7.2 billion in taxable gains. To put that in perspective for you, in the same quarter of 2025, they only sold $4.7 billion.
So that's, what, a 5-fold increase in their liquidation rate year over year?
Exactly. And looking at the sell-off, my gut says they are predicting a market crash.
You think so?
I mean, you do not dump $24 billion in public equities in a 90-day window if you think the stock market is healthy and reasonably priced. To me, this looks like an individual investor looking at their retirement portfolio, deciding the top is in, and just stuffing everything under a mattress, albeit a mattress made of interest-bearing government debt. So I have to ask, is this massive $24 billion stock sell-off a giant warning sign about the stock market or just standard portfolio housekeeping?
Well, I have to respectfully disagree with that framing, actually. It's tempting to view a sell-off of that magnitude as a panic move, but what's fascinating here is the sheer math of what that mattress is paying them while they sit out.
Okay, fair point.
They are not running for the exits, you know. They are adopting the ultimate defensive posture because the yield environment allows them to. The filing notes they earned roughly $3 billion in discount accretion and interest in just one quarter.
Wait, let me pause you right there. I know how standard interest works, but discount accretion is one of those accounting terms that always trips people up. Can we break down the actual mechanism there?
Oh, absolutely. So when you buy a short-term treasury bill, the government doesn't usually pay you a monthly coupon or an interest check.
Right.
Instead, they sell you the bill at a discount to its face value. So you might buy, say, a $100 bill for $98 today. When the bill matures in 3 or 6 months, the government hands you $100.
Okay, so that $2 difference is your profit.
Exactly. But in corporate accounting, you don't just recognize that $2 all at once at the very end. You slowly recognize a portion of that gain every single day you hold the bill.
Ah, I see.
That process of the value slowly climbing from $98 to $100 on the balance sheet, that's called discount accretion.
Wow. So that $3 billion they made in a single quarter is a mix of traditional interest from cash accounts and the daily mathematical ticking upward of hundreds of billions of dollars in discounted government bonds.
Precisely. I mean, they are making $1 billion a month in practically risk-free return just for sitting on their hands.
That is wild.
Right. And you have infinite capital and really no institutional pressure to deploy it immediately. You can afford to wait for the perfect pitch. They are building a fortress of liquidity so that when a true market dislocation does happen, They are the only entity with the cash on hand to act as the buyer of last resort.
Okay, so if they're setting themselves up to be the buyer of last resort, they aren't just hoarding this cash in a vault forever. While they are shedding fractional shares of public companies on the open market, they're simultaneously using that capital to swallow entire businesses whole in private transactions. Which brings us to the $9.5 billion move they made right at the start of the year.
Yes, the OxyChem acquisition. This is just a masterclass in how you structure a deal to capture all the upside of heavy industry while completely amputating the historical downsides.
So on January 2, 2026, they purchased OxyChem, which is Occidental Petroleum's chemical division, for $9.5 billion.
Right.
And the acquired assets are actually valued at $10.8 billion, mostly weighted in physical property, plant, and equipment. But the detail buried in the contract that really caught my eye is the liability structure.
Yes, the carve-out.
Right. The agreement legally stipulated that Occidental retains OxyChem's legacy environmental liabilities. It feels like buying a fully restored vintage house, but forcing the previous owner to sign a contract paying for any future termite damage they might have caused decades ago.
That structural separation is the entire ball game in chemical mergers and acquisitions.
But I'm looking at their existing portfolio, and they already own 26.9% of Occidental's common stock.
Yep.
Plus, they hold $8.5 billion in Occidental preferred stock, yielding 8%. And they hold warrants to buy another 83.9 million shares. They practically own a third of Occidental already. So why buy the chemical wing outright? Like, how does an acquisition like this change their overall exposure to the energy sector, considering they already own so much of Occidental?
So if we connect this to the bigger picture, it actually pivots their exposure. OxyChem isn't about oil exploration or drilling. They manufacture basic chemicals, polyvinyl chloride, chlorine, caustic soda.
Oh, okay. Yeah.
Yeah, we are talking about the fundamental, unglamorous compounds required for municipal water treatment facilities, pharmaceutical manufacturing, and heavy construction. They're essentially buying the invisible building blocks of the U.S. industrial base.
The stuff the modern world literally cannot function without, regardless of what the stock market is doing.
Yes, exactly. But historically, chemical companies trade at a deep discount on Wall Street because of the unpredictable tail risk. Like if a chemical company dumped something in a river in 1974, a lawsuit in 2026 could literally bankrupt them. So by severing the legacy liabilities and leaving them with the parent company, Occidental, they stripped the poison pill out of the investment. They acquired the cash-generating economic engine and legally just left the exhaust pipe behind.
It is brilliant legal maneuvering. However, it also exposes a glaring vulnerability in their broader portfolio, I think, because, sure, they legally sidestepped Mother Nature's historical chemical toll with the OxyChem deal, but they are currently taking direct, massive financial hits from her across their other physical infrastructure.
Ah, you are looking at the railroad, utilities, and energy segment, the RUE division.
I am. And honestly, reading the RUE segment of this 10Q feels less like reviewing a financial statement and more like reading a federal disaster report.
Yeah, it's pretty grim.
This segment is insanely capital intensive. They hold $184 billion in physical property, plant, and equipment. We're talking thousands of miles of railroad tracks, locomotives, and power plants just left out in the elements.
Right.
And the filing dedicates significant ink to the legal nightmares facing their Pacificorp utility subsidiary, specifically tied to the 2020 and 2022 wildfires.
Yeah. The risk profile for operating a utility in the western United States has fundamentally broken the traditional financial models over the last 5 years.
It really has. The 10Q explicitly names the James case in Multnomah County's Circuit Court, detailing punitive and economic damages scheduled to hit right around April 2026. And, on the insurance side, Q1 2026 was quiet, but Q1 2025 saw $1.1 billion in losses from Southern California wildfires alone. So here's where it gets really interesting. We constantly hear Wall Street analysts debate interest rate risk or currency risk, but when you are operating at this massive physical scale, how does a financial behemoth actually price in the unpredictable, catastrophic physical risks of Mother Nature?
It's a great question. What you're observing in this document is a brutal dichotomy between two completely different models of risk management. Think about the company's massive insurance and reinsurance operations.
Yeah.
Insurance is incredibly agile. If climate patterns shift and coastal hurricanes or western wildfires become more frequent, the insurance division just reevaluates the math.
Right. They just adjust their premiums.
They adjust premiums annually, or they decide to simply stop writing policies in those zip codes altogether. They can pack up their capital and leave.
So they aren't tethered to the ground. If a region becomes unprofitable to insure, they literally just walk away.
Exactly. But the utility and railroad wing does not have that luxury. A high-voltage power transmission line is literally anchored into the earth. You cannot move a substation out of a fire zone.
Yeah, that makes sense.
And as the filing details with PacifiCorp, these physical assets are getting hammered by a legal concept called inverse condemnation.
Oh, I saw that term in the notes. Break down inverse condemnation for us, because it sounds like eminent domain, but that doesn't fit a wildfire scenario at all.
Right. Well, it actually originated with eminent domain, the idea that if the government takes your property for public use, they have to compensate you. Over time, courts in certain states applied this to public utilities, establishing a standard of strict liability. It means that if a utility's equipment is involved in sparking a fire that destroys private property, the utility is on the hook to compensate the property owners.
Okay, even if it was an accident,
Here's the kicker.
meh.
They have to pay even if the utility wasn't negligent. Even if they maintained the lines perfectly to code and say a freak windstorm blew a healthy tree into the wire, if their power caused the spark, they pay.
Wait, really? That is wild. So they are financially responsible for acts of God simply because their infrastructure was the ignition point.
Yep.
Well, that completely explains why a single circuit court case in Multnomah County commands so much attention in a trillion-dollar company's financial filing.
It does. And this raises an important question that extends far beyond this one company. What is the ongoing viability of operating critical infrastructure?
Right.
If the legal and physical risks of maintaining a power grid continue to generate multi-billion-dollar liabilities without requiring negligence, the cost of capital to maintain that grid will skyrocket.
Oh, definitely.
Now, this specific company has $400 billion in liquid assets, right? They can absorb the punitive damages. But it proves that even the best-run physical assets are uniquely, painfully vulnerable to the physical world.
So they have this heavy, grounded physical vulnerability with their utilities and railroads, which makes me wonder, is that why they balance their portfolios so aggressively with highly intangible, brand-driven consumer stocks?
It's a very interesting way to look at it.
Because a wildfire or an inverse condemnation lawsuit cannot burn down the concept of an iPhone or a credit card network. So let's look at their $288 billion equity portfolio, because the concentration is intense, and the accounting quirks here are fascinating.
The equity portfolio definitely gets the most media attention, but it's the accounting methodology that reveals their actual strategy as long-term owners.
Okay, so out of that massive $288 billion stock portfolio, an incredible 61% of it is concentrated in just 5 companies.
The core 5.
Exactly. American Express, Apple, Bank of America, Coca-Cola, and Chevron. Let's start with American Express. The filing shows they own a massive 22.2% stake in the company. Normally, under standard accounting rules, if you own over 20% of a company, it triggers a different type of reporting. But the 10Q notes, they account for Amex at fair value because of a passivity agreement with the Federal Reserve and an agreement to vote with the board.
Yeah, their passivity agreement is a crucial mechanism. When you cross the 20% ownership threshold of a major financial institution, or 25% under certain statutes, you trigger the Bank Holding Company Act.
But why does the Federal Reserve care if a conglomerate owns a quarter of a credit card company?
Well, because the Federal Reserve heavily regulates entities that control banks to ensure systemic stability. If you legally control a bank, you yourself become subject to intense banking regulations, capital requirements, and regular examinations by the Fed.
Oh, I see.
Yeah, and a conglomerate that owns railroads, furniture stores, and ice cream companies absolutely does not want the Federal Reserve auditing its entire corporate structure as if it were a bank.
Right, that would be a nightmare.
So they sign a passivity agreement. They formally promise the Fed that they will remain a passive investor. They agree to vote their shares in line with the board's recommendations and to not exert operational control. In exchange, the Fed lets them use standard fair value accounting and avoids regulating the parent company like a bank.
That is a brilliant regulatory loophole. You get to reap the economic benefits of owning 22% of a global financial network without catching any of the regulatory friction.
Exactly.
But then we look at their holding in Kraft Heinz, where they own 27.5%. For Kraft Heinz, they do not use fair value. They use the equity method, and the math here is bizarre.
Bizarre is a good word for it.
The official carrying value of Kraft Heinz on their books is recorded at $8.69 billion. But the very next paragraph states the actual fair value, what those shares are trading for right now on the open market, is only $7.32 billion.
Mhm.
That is a $1.4 billion gap between what the accountants say it is worth and what reality says it is worth. Yet they haven't recorded an impairment loss. To me, it's like a collector holding onto a comic book that has dropped in price, refusing to admit they've lost money just because they haven't sold it yet. So what does this all mean? How can a company legally ignore a $1.4 billion drop in value on their balance sheet?
It is easy to view it cynically, but it actually comes down to a highly specific, very subjective accounting concept under the equity method called other than temporary impairment, often referred to as OTTI.
Walk me through OTTI. How do you legally ignore a $1.4 billion drop in market price?
Okay, so under standard mark-to-market accounting, your balance sheet has to reflect the stock price at the end of the quarter. If it drops, you take the hit.
Right.
But under the equity method, which you use when you have significant influence over a company, a drop in the stock price doesn't automatically force a write-down. You only record an impairment charge if management believes the drop in value is permanent, that it is other than temporary.
So management just gets to declare, oh, we don't think this is permanent, and the accountants just sign off on it. That seems wildly subjective.
It is subjective, yeah, but it requires justification. Management looks at the underlying fundamentals of the business, completely independent of Wall Street's current mood. The 10Q points out that Kraft Heinz is still a highly profitable enterprise.
Right.
I mean, they generated net earnings of $651 million in the latest quarter reported. They are selling ketchup and macaroni. They are not going bankrupt anytime soon.
True.
More importantly, to avoid the impairment charge, the parent company must demonstrate both the intent and the ability to hold the stock until the price recovers.
Ah. And because they are sitting on nearly $400 billion in liquid capital, nobody can argue they lack the ability to hold. They will never face a margin call. They will never be forced into a fire sale to raise cash.
Exactly. It highlights the ultimate luxury of the financial fortress they have constructed. They possess infinite patience. They could hold Kraft Heinz on their books, collect the dividends quarter after quarter, and just wait 5, 10, or even 20 years for the market to eventually agree with their valuation. Wall Street operates in 90-day quarters. This balance sheet is built to operate in decades.
That perfectly brings this entire document into focus. Let's briefly recap the journey we just took through this 10Q because it paints a really vivid picture of early 2026. We started with a staggering $339 billion mountain of U.S. Treasury bills, heavily fueled by an aggressive $24 billion liquidation of public stocks.
Earning them roughly $1 billion a month in pure interest and discount accretion while they wait.
Right. Then we explored how they deploy that capital, looking at the shrewd, liability-free $9.5 billion OxyChem acquisition. From there, we confronted the brutal physical and legal realities of utility wildfires in their RUE segment. And finally, we ended on the supreme accounting patience demonstrated with Kraft Heinz.
Yeah, every disparate section of this filing points toward the exact same strategic philosophy, which is durability above all else.
And that is exactly why you should care about the dry, dense pages of a corporate 10Q filing. This isn't just math, it is a masterclass in risk management. It shows that true financial strength isn't just about making money, it's about building an architectural fortress that can withstand everything from market crashes to natural disasters.
It really forces anyone reading it to evaluate their own financial strategies on a much longer timeline, which, leaves us with one final unexplored thought to ponder.
What's that?
If one of the most successful capital allocators in history is currently holding nearly $400 billion in liquid cash and government debt while actively shedding public stocks, what massive future economic shock or unprecedented elephant-sized acquisition target are they quietly preparing for that the rest of the market hasn't priced in yet?
Wow. It definitely makes you wonder. Because when you look at the financial map they are drawing today, that massive cash mountain isn't just distorting the landscape. It might be the only safe high ground left when the weather actually turns. Thanks for joining us on the deep dive.